just say the looking at the documents, how they're constructed, what you can use out there, and then going on to manipulating the financial statements, what you can do to fiddle with what's there. What I do, fellow presenter Peter Haley and Dan Haynes, and Ben, is he still snuffed out? We're in the forensic section. The business valuation, financial statement analysis is what we do for a living. We've got some pretty little pictures of us there. It's all in the notes, so I don't need to go through. Accounting humour.
Although accounting hasn't changed in centuries, it really hasn't.
And I think if we're going through this, that's not real. That's the 1300s. That's when they invented all of this stuff, and it hasn't really changed since. And that's clearly not right, because we don't do that. Much as we'd like to. What are we doing today? We look through some of the definitions and accounting rules that actually go into actually constructing financial statements. If you bear with us for about 20 minutes, we go through it's dry. This part of the accounting is dry. It's really important though to actually lay the foundation. If you understand how it gets put together, you can go back and pull it apart. And quite often we get asked questions like, there's heaps of money in the bank account, or there was heaps of money in the bank account. It's gone. He's been taking or she's been taking, they've been doing the wrong thing. And what this session highlights is that if it's gone into the system, you will find it. It's just a matter of actually finding the trail and working your way through it. If it's in there, you will find it. So from that point of view, the things about the loan account, what's happening in the loan account, what's happening with the sales, what's happening with the wages. By asking for the right document, it's all there. You've just got to ask for the right document and know what you're asking for. So definitions, accounting formula and rules, double entry accounting system, looking at the delightful journals and ledgers, and we often hear that you guys know nothing about that, but we also know that you did your trust accounting. So you know you actually do a bit of a background in this stuff. Constructing the financial statement, looking at between 4 and 5, looking at, as a result of all of that, what documents can you ask for and why? Then going into a little bit more interesting stuff and saying, how can you manipulate financial statements? How can you actually, within the accounting rules, change a couple of things and they present something completely different? What should we be looking for? So, what is accounting? It's recording transactions, assets and liabilities. And it's literally all of these. There's rules that go into that. It got created back in the 1300s. I'm reading the book Dan Brown, The Inferno, and I was reading along. I got very excited when I read that in the Medici era. The second guy he came through and he commissioned someone to go and do it. Double entry accounting system. I got very excited because we're doing these. But also shows why I'm an accountant. What is it? Double entry accounting system. We'll go through that. It's all about debit and credit. It's all about following these rules, classifying it, and it all just flows through item by item, and everything else is just summarising that information. There's things that we call generally accepted accounting principles. Who says accounting is right? When you look at a set of financial statements, who says that's right? Have they followed the generally accepted accounting principles? Do they need to follow the generally accepted accounting principles? And by the end of the day, what you'll get to is don't trust what you see. Be inquisitive. You can change the actual what's there very easily. If they've produced management accounts internally, so they've got the bookkeeper in there, they can do whatever they like. And you can present whatever you like. You can leave things out. Who's going to know? Most things are prepared for tax office. What do you want to do when you're presenting something to tax office? Show you've got the lowest profit. So the lowest profit payment is tax. It also helps that your damages are going to be different, or your values for matrimonial will be different as a result of actually the way to benefit. What are financial statements? Financial statements, there are 3 things that are there. Profit and loss and balance sheet, you'll all be aware of those. And you've also got the notes for financial statements. You'll see these slides and you go, this really is not very high level. Accounting is not very high level. We're not that smart. When you actually go through it, it's really this simple. So we look at profit and loss. What is profit and loss statement? You're looking at revenue and expense items. Revenue minus expense is equal to profit. So when you look at the profit and loss statement, you'll see all the revenue items, you'll see all the expense items. The difference between the two of those is going to be profit. The big thing about a profit and loss statement is it's summarised for a period. So if you see a profit and loss statement for the year ended 30 June 2016, it's a summary of all the transactions that have happened for that 12-month period. What it won't tell you is that all of those transactions happened in the first month and haven't trailed since, or it's been consistent through the whole period, what trends are there, what seasonality is there. It won't give any of that information. But there's other information you aren't able to get that. In relation to the balance sheet, what's the balance sheet? Again, not mind-blowing. You've got your assets, your liabilities, and your equity. What is an asset? This is important. An asset is anything you're going to actually get a benefit into the future. So it's not just your things like your cash and your debtors and your work in progress, your plant equipment you're building. It can be your chosen action. It can be something you get into the future. Your goodwill. It can be your intellectual property. Just because it's not on the balance sheet doesn't mean it doesn't. Assets classified between current and non-current. If the benefit's going to happen in the next 12 months, current. If the benefit's going to happen in a grace period, it's non-current. So things like cash, debtors, WIP debtors, we hope it's going to be 12 months. WIP, we hope it's going to be 12 months. They're all your current. Then you've got your non-current, which are your hard and fast, your tables, your buildings. Hope they're going to be going through into the future. A liability is just the opposite. It's something is actually going to come into fruition in the next 12 months or greater than 12 months. So it's something you owe. The difference between, one of the differences between assets and liabilities, and assets is current or non-current. With a liability, it can be both. So if you have something like a lease, the next 12 months worth of lease payments will be current. After your 12 months, they're going to be non-current. So it's going to be the one liability split between the two. The difference between your assets and liabilities is your equity. You own a building, you've got your own house, it's worth 500 grand, you've got 400 grand worth of debt. The difference between the two of those is the equity in your house. The same with accounting and difference between the two. So the terminology we use there, assets minus liabilities, is equal to your net assets. So those family lawyers in the room, your net assets is largely where we head to when we're trying to do a business valuation. So the assets minus liabilities, and the assets we'll go through and work out is their goodwill. There's other things you need to look at. What are the real value of the liability, or the real level of the liabilities, differences in net assets, which is also the equity. And the last one, which is often forgotten, the notes to the financial statements give you more explanation. Now, they don't always exist, but if the accountant prepares notes, you'll get a lot more detail in relation to the profit and loss and balance sheet by looking at the notes. So you'll see there that in the balance sheet may say cash, $1 million. If you go to the notes, it'll actually say you've got your petty cash, you've got your trading account, your GST account, you've got your term deposit. It gives you a split of what's there. Receivables, how many of those are customers, and how many of those are related party transfers. It'll actually give you a split of what's there. And same with your liabilities. Quite often give you a lot more information in relation to lease liabilities and commitments to the place. May talk about contingent liabilities.
You normally find is small, medium stuff that we tend to, I think most people in this room to deal with. Has anyone ever seen a public company's financial statements? They might have 100 pages in that, of which you've got one page of profit and loss, one page of balance sheet, probably 98 pages of notes. All, there's a lot more detail in there, but typically, the typical thing that turns over giving us 10 or 20 million, essentially a family business, will normally have most of the detail that you're going to get over the financial statement in the profit and loss statement and the balance sheet.
So that's financial statement. Again, nothing too mind-blowing there. This is where it gets a little bit confusing. This classification, each transaction gets classified between both revenue and expense items or the asset, liability, or equity items. On the left-hand side, we've got some examples. On the right-hand side, we've got those options, what we just talked about. If we looked at advertising, what would you classify that as? Expense? Yep. Unless you're receiving the advertising like revenue, ordinarily expense. Prepaid advertising? got benefit into the future. You've paid it now, you get all the advertising into the future. So they're right. Accumulated depreciation. And in relation to accumulated depreciation, what would you say depreciation is?
Out of the categories on the right-hand side.
Yep. Why? We go to, you're right, that's exactly where it fits in, but it's a little bit of a different, bit of a twist on it. What's depreciation? So you actually have a table. It's got a life of 5 years. Every year, you're using 1/5 of the actual benefits that's there. So in the future, we only have, at the end of first year, we only have 4 years left. 2 years, we only have 3 years left. That's a car, whatever it might be. So you're utilising the actual, you're exhausting the benefit into the future. As you exhaust that benefit, you have depreciation. That's something you put through as an expense item. So you'll see depreciation there, that's actually the writing off of the assets, the benefit or the value of those assets. Accumulated depreciation is just to accept it is, it's the amount adding up each year. In the actual balance sheet, you'll see plant and equipment. When you buy it, it's worth 100 grand. Each year you depreciate it by $20,000. In the balance sheet, you'll see cost $100,000. After the first year, depreciation $20,000. After year 2, another $20,000. You'll see accumulated depreciation $40,000, $60,000. So all that information is sitting in there. So if you actually get the depreciation schedule, you can do things like how long they had it, what the cost, what does that actually reflect in your car, does that reflect what the actual market value might be by looking at car sales. So you're looking at information, what additional information you get out of that there. Accumulated depreciation is exactly that. It's a non-current asset, but it's what we call a contra asset. It actually sits underneath the current asset as a negative, reducing the actual cost.
Sometimes some people think depreciation is not a real expense because it doesn't involve actually paying cash out year by year. But certainly from an accounting point of view, it's treated as an expense. And you can almost think of it, you need to put aside, your car's going to wear out in 5 years. So you've got to put X amount aside each year to buy a new car in 5 years' time. So you might have to pay the cash out now, but you need to build up a little kitty to buy one in 5 years' time. That's the way of thinking about it.
This is obviously getting harder as we go through. An asset revaluation reserve. You've got a building for $100,000. You picked it just right. In 10 years' time, it's now worth $1 million. In the, if we go back to, we had our building was worth $100,000. The liability was $50,000. We had equity of $50,000. That building is now worth $1 million. It's still $50,000. We've increased by $900,000. Increase the asset, $900,000. Liability is the same. What else has to change? Your equity. So you can go and revalue your asset. You can change it in your book from $100,000 to $1 million. And the directors can do that. You can start seeing the manipulation side of it coming through. But if you actually revalue an asset, you'll also see something in the equity section of the balance sheet called asset revaluation, which is, again, what you were trying to find is flags to actually think about things. If you ever see an asset revaluation reserve, the assets aren't, some assets, an asset is not sitting in there at a cost price. It's been changed. They've revalued it. They don't need to do it to a registered valuation, and directors can revalue it themselves.
Yes, Joe, one of the main points of that is when you're normally looking at a balance sheet, everything's the cost. But John said, see a revaluation reserve down in the equity section. Be aware that something's down at cost. And that's the other thing to know that, okay, that's what it costs, but when did it cost that and what's it truly worth today? So John spoke earlier about the generally accepted accounting principles, and one of those is called the historical cost convention, which pretty well means that you bring everything into the books at cost, and that's your starting point. So when you're actually, when we do a valuation, you start with the balance sheet, but you almost ignore those values, and you've got to consider each individual item. Are the debtors really worth that? Is the stock really worth that? Is the building really worth that? To then work out what the total net equity is.
there's general sort of perception out there by a lot of people that if it's in the financial statements, it must be right. And the reality is there's a whole lot of ways to change what's there. It's called manipulate. It doesn't necessarily mean it's wrong. It just you should be aware that it's actually changed, so it's being done correctly. Resurface the bitumen driveway with cement. So you have your premises has had where it's actually been working over the years, the water's got in, bitumen's gone everywhere, it's cracked, there's holes, there's potholes. They rip the whole lot up and stick a really nice concrete slab down. It costs $200,000. That's it. The alternative? Expense. Yeah. So it's going to be an asset or an expense. With that, if we actually treat it as an asset, profit stays up, assets are up, so the actual balance sheet is stronger. If we treat it as an expense, profit drops by that $200,000, and we don't actually see the benefits sitting in there in the balance sheet. So how they treated those things. There's an old tax rule that basically puts out there, this is the principle that if you have a repair that takes it back to its original condition when you bought it, that's a repair, you can expense it. After that, you put it in there as an asset. In this case here, cement's better than bitumen. If we actually improved what's there, we should put it through an asset. And when we write off if the bitumen been done 3 years ago and it's done poorly, and there's still 20 grand in the value there as an asset, that gets written off. That's then the expense. So all of these things are starting to go through the profit and loss statement and balance sheet from year to year without having the story behind. How do you find these things? And this is one I always love. Pending lawsuit. Useless issued statement of claim for your client against a legal practice. Someone else sitting in this room.
Sorry, just a clarification.
I want you.
Is it a lawsuit against your client or a lawsuit your client bringing?
We'll just say you're bringing against somebody else. Or no, we'll make it an hot seat. Someone's actually put a statement of claim against you.
Not current liability.
Contingent liability? Why is it contingent?
Because it might not actually require you to pay out any money.
Yeah. So that's exactly right. So if someone hits you with a claim for 100 grand. Do you owe 100 grand at that point? What do you need to actually owe 100 grand? A judgment. What if you try putting it in there? What value would you put in? 100,000? What do you think it should be? Should you put legal fees in there? What about the fact that you'll actually do a claim against them, your counterclaim?
Or you might be a builder who has insurance, so you've only got to pay the excess. You just put in the excess because your insurance is going to pay the rest. I actually had that recently. I had to. The only time I've ever seen a pending lawsuit in a set of financial statements, the QBSA engages because builders have got to meet certain financial licensing requirements. So this guy, to meet his level of assets, he put in there a contingent asset being this claim he'd made against one of his suppliers. So he'd actually built one of the buildings in town, and all the windows were defective. So it was like $1 million on it, something huge. He basically, it cost him about $3 or $4 million to fix them all, to go back and reseal them all, and then stuck them in. It was only then they realised they leaked and everything, so they had to go back and anyway, it was a kerfuffle. But he was quite, all he'd done was lodge a claim for $8 million against the window supplier for what they cost him because they defective goods, and then he was trying to tell the QBSA that he had sufficient assets for this level of turnover. And we were asked to provide expert opinion as to whether that was a real asset or not. Of course, the answer is no. So he lost his license. Which seems a bit harsh because the reason he was in the real financial trouble was because he had to fix these windows. Yeah, it wasn't really his fault. Yeah.
You can see here, this is a little bit grey. How you classify is going to affect how they actually financial statements. But looking in past this, how have they done it? Double entry accounting system. Basic accounting. Every transaction has what we call debit or a credit. There could be multiple debits, there could be multiple credits. But we actually say the debits are on your left-hand side of the room, your credits are on the right-hand side of the room, your debits and your credits must equal. So for every transaction, it affects at least two things. So if you actually example we're about to use. We pay rent for something. Pay rent in cash. Rent, expense, cash, asset, one going on somewhere. So these are trying to classify that transaction, that transaction, that transaction. Accounting is just basically classifying individual transactions, adding them all up.
So the bit we just did, the classification, that's, there's a little bit of grey sometimes in that. All this stuff gets ruled. So once you decide where the classification's going, you've got to follow these rules. Black and white.
These are the rules that were done in the 13th century. They haven't changed since. You could swap them all around, provided you do it consistently. They've all worked out the same way. Around the world, it is done all the same way. They present their statements a little bit differently. Essentially, that's the same thing. Now again, we'll go through these individually. Now, a lot of this, what we're talking about, comes from pre-computers. So, embarrassed to say, when I started work, it was a good number of years we had computers. Everything we did was manual. So a transaction would have to remember the old, the old shops that still do it sometimes today. There'd be a box with cards in it. Each transaction that's given these cards for the transaction, or they have a journal book that writes things down and they actually go and post things manually. Like one of my friends got a very successful vet practice. He will not put an accounting system. He does everything by hand. Turns out millions. He does everything by every Sunday. He sits down and he will not feel that's how I should feel my business. I've got to do that myself. This is why. But all of this stuff with the accounting system, all of this is happening in the background behind the accounting system. So all these records still exist. We just no longer have to manage them. So, more accounting rules. Each of those things we talked about earlier, your asset, liability, equity, revenue and expense, all have a nature. Assets are a debit, so the left-hand side of the room, and expenses are a debit, left-hand side of the room. Liability and equity on the right-hand side of the room, revenues on the right-hand side of the room. Revenue and expenses, they're opposite, they must be opposite. We also, before we had in there that we know that an asset minus liability is equal to equity. Those who love maths, we change that around so that asset is equal to liability plus equity. Therefore, assets, liability, equity must be on the opposite side. We always ask this question. An asset is a debit. Who feels that's right? And why? Why do you feel an asset should be a credit?
Would it have anything to do with bank statements?
Spot on. From very early age, we see our bank statements. When you put money in, often these days, when you put money in, you'll see a balance in the bank statement that says credit. I have 5 cents credit. Why is it a credit? Why is it not debit? Debit?
Nothing is that.
You're looking from the bank's point of view. So from that point of view, the bank owes me 5 cents, so it's credit.
Yeah.
So dead right though. It's round the other way. So that's the easiest way, and this is where going through when I first did it, a liability is credit. Okay, credit card, you owe money, I owe money. So our credit card is a liability. That's how I remember it, and then I work backwards. Credit card, equity assets is the same, assets is opposite. We'll work out here. Now,
if you have a debit card account where you actually have an asset, so credit cards are liability, debit cards are asset cards.
And revenue minus expense, if you've got more revenue than expense, you've got profit, which will be more credit. And we know at the end of the year, that profit makes you worth more, increases your equity. And that's the formula that goes into it. And that's how the whole system works.
I actually find a few people don't get that bank statement analogy anymore because no one gets that statement. So if it's red on the screen or it's black on the screen, that's what you look at now, don't you?
So that's another rule. Next rule. If one of these is going up, it goes up on the nature of it. So if an asset goes up, it's going to be a debit transaction. If an asset goes down, it's going to be the opposite, a credit. So each of these, if they're going up, it's going to be one of those opposite. pay rent $3,000 with cash. Here's a transaction, so we do a journal for this. We whip through this. We know we need a debit and a credit. What's our debit? What's going up? What's going down? So paying rent with cash. So rent's going to be a expense, cash is going to be a asset. Rent's going up. It goes up by that nature, so we've got our debit. Cash is going down. So it's the opposite. That's credit.
So this is what the bloke with the green eye show used to sit up on the table and do all these journals and stuff. And as John said earlier, people sort of forget the two sides of the entries, because if you were sitting, does anyone ever use MYOB or QuickBooks or any accounting package? When you go to a screen that says spend money, for example, in MYOB, it knows, and you've got to tell it which bank account you're going to spend money from. So it knows it's going to put all the credits to there. All you've got to tell it is the debits. But it feels like you're just doing only one side of the entry all the time, because you're only telling it one side. But in the background, when you first go in, it knows it's doing the credits. So the software is still doing debits and credits everywhere.
So that's the entry. So if you make every single transaction, there's a journal. Just lock that away when we start looking at information. Next one. We buy a desk for $800, 2 accounts.
So I should just say on MYOB and stuff, when they invented it, in that spend money screen, I was explaining it to one of our graduates recently, and I said, well, you can see that the screen just looks like a check. And I go, what's a check? And it is. You fill in, you type in the screen where you used to write payee, the dollars you put up in the corner, you put the date up in the end in the corner, and you sort of forget how no one writes checks anymore.
2 accounts. 1, 2. So we buy, we're paying cash, paying for it. Next one's debt. So what? We're buying cash, asset, debt, craft equipment, an asset. So we've got one asset going up, one asset going down. Furniture going up, cash going down. That's it. Next one. Cash sales. So we've got revenue and cash. Cash going up, revenue's going up. That's it. If you can do this, accounting, really the rest is just like. So that's our journals. So imagine for a business, every single transaction that happens in a business has this in the background. And you can drill down your information very easily in our accounting system to get this information. Then what do? When we're doing the accounting process, first thing we do is do our journals. We post those journals to ledgers, which we'll go through shortly. We balance those ledgers to get summary amounts at the end of the period. We put all those summary amounts onto a sheet called a trial balance, which we'll show you shortly, and then we make it look pretty. That's what you see. What we want to show you is all of that information available. Ledgers. Once you've done your journals, we do what we call posting those journals to a ledger. So we had 3 transactions before. The first transaction was we paid rent with cash. What we do is, at the end of every period, we actually post those journals to a ledger. And all that means is those 2 accounts that are used, we post. So you look at your cash, look at your rent. So we debit our rent expense account, so we debit rent. Credit cash, credit cash.
This is what John said earlier about the left and the right-hand side. When it used to be manual, you used to have a line in the middle. If you're going to debit something, you stick it on the left, on the right for credit.
We go to the next transaction, which was buying some furniture for cash. We put that through. Third transaction was we make a sale, $5,000. We put that through. And this is what the computer's doing all of this in the background. At the end of the accounting period, we need to do what's called a balancing the ledger. So you'll see here, we have $5,000 cash bank on one side, $3,800 on the other side. Therefore, there's $1,200 more there. So when you see a balance sheet that has cash, that's what you'll see. So once you've done all the accounts, you then take all of those balances and put it on a trial balance.
This is what you used to do when you did it manually.
All those accounts from the trial balance which you're seeing now. So you'll see on that list there, you've got all the income items, expense items, assets, liabilities, and equity. If you draw a line underneath, I think it's the income tax expense. All above that's your income and expenses, all below is your assets, liabilities, and equity. Literally all you do to get your balance sheet is to make that look pretty. Take all the items above the line, that's your profit and loss statement. All the items below is your balance sheet. The reason which the trial balance is done is all your debits and credits mark that up and down. So why do we put you through this pain? There's a whole heap of documents that are available. So now the USBL manual, now it's all computerized. This information is very easily attainable by just asking for the right document. The first document is your chart of account. If you take the trial balances off there, ignore the actual values on one side, and imagine there's a coding system on the left-hand side. Your revenue items will be the 1000 series, your expenses, the 2000 series, whatever it's set up. Chart of accounts is your index to how your accounting system is set up. You then have journals. You can get a complete listing for a period of all the journals, all the transactions that have happened. If you imagine with most businesses, they do a lot of transactions. You might have 1,000, 10,000, which if you're looking for a specific one, there's probably a better way to get to this guide. Next one is your general ledger. This one's gold. And before we really use all of these easy accounting systems like MyOb and Xero and Reckon and the like, the general ledger is what we ask for. Give us a detailed general ledger. What that does is for, imagine your bank statement. On your bank statement, you get, there's the date, there's all the transactions, there's the debits and credits that have gone through. That's all it is. It's round the other way if you look at cash bank bills from the consumer's point of view, the customer's point of view. You get a listing of all the transactions that have actually gone through that account, that ledger. So if you're looking for loan accounts, if you're looking for wages, or what the telephone is, have they been running telephone, their own private telephone through there? If you know that rates, they should only have 4 rate bills a year, they've got 6 going through the account, there's someone else's rate bills attached. So the detailed general ledger is a transactional listing, everything goes through those. If you ask for the detailed general ledger for a period, you'll get those listings. It's something that actually is easily attainable. Trial balance, what you've got in front of you, there's no extra information in trial balance you won't see in the financial statement. If you're asking financial statements, you've really got everything. And obviously the financial statements, including the notes. The notes give you that additional information. That's to that point. There's more stuff you can do. You know, I talked before about a profit and loss statement. The profit and loss statement gives you all the transactions for a period. It doesn't give you any details of how many transactions there are. Is it one transaction, $1 million, or a million transactions of $1? We don't know if everything's happening in July of the financial year or consistently throughout the year. Is there trend analysis? What's happening? So the next thing we can ask for, some of the things we can ask for, we can ask for sales summaries or periods. We can ask for doing things like MYOB. They can do what's called a multi-period analysis, which will actually give you profit and loss for each month, the whole period. You can see it all in pretty good trend analysis, what's gone up, what's gone down. The debtors and creditors age trial balance, how quickly are they collecting things? What's their average balance? Are they financing things through their creditors? Is there a problem collecting from their customers? And with information at different dates, starts giving you more information.
So we're not suggesting you go out and ask for all this stuff, but just to understand it is all there. And hopefully if you're getting a valuation done or something like that, as a valuer, you know, if he's saying, well, what is the true balance of the debtors? The first thing we go to is gauge trial balance. If everything's in 90 days, we start to question, well, is it really collectible? Have we got to adjust that debtors balance for some uncollectibles or bad debts or whatever? And then, of course, if the debtors isn't collectible, you haven't really made those sales either, have you? So then you've got to go back to the profit and loss statement and say, well, what are our true ongoing sales? Maybe what we did in the last 12 months, we only made those sales because, you know, we had this massive increase in turnover because we were selling to people who never pay us at stupid prices or something.
And what we're trying to find with all of this stuff is what's the story behind the financial statement. Instead of actually just looking at here's numbers on a page, what are those numbers actually saying? There's an analogy when Matrix came out, everyone sort of jumped on the analogy of Matrix. You know, with for you and I looking at the computer screen for the Matrix, we just saw all the numbers flashing up over the screen, but then Neo comes through and he can actually see the moving picture there. That's what we're trying to do. We're trying to see what's the image, what's the story sitting in behind the numbers. Now, if you've got the actual the software to read it, the accounting data file is gold. Because any report you want, you just have to dial up the report, push print, and that report spits out. So any of the stuff we've asked for, but also sales, customer analysis, what's gone up, what's gone down, when are they making sales, are there trends for a customer going like this, trends for a customer going down like this, does the story we're being represented when we've done the interview marry up to what the actual financial statement is coming? This data file for us is magic. Any questions on that? Now it's fun stuff.
Okay, so hopefully you'll understand the manipulation of it more now, knowing exactly how you put together a set of financial statements. So why would someone want to manipulate everything? Anything? Yeah, or potentially more profitable, yeah. That's normally the. Some of the reasons, finance, so that's where you want increased profitability. If you're going for some form of finance, the bank. Income tax. Now, most of the set of financial statements you'll look at out in a small, medium business land are prepared predominantly to come up with taxable income to use as the basis for their tax return. So keep that in mind that most people probably prefer to reduce their profit for tax purposes than increase. Occasionally, they don't. Anyone ever think of a reason? It hasn't happened for a good many years that when the tax rate changes. So if the tax rate's going to be going up, they might actually try and declare more income this year if they know, company rate is currently 30%. Through the 80s and 90s, it went 36, 39, 43, back to 36, back to 30. It's been all over the shop in the last 30 years or so. So people fiddle with their taxes when the tax rates are changing as well. Reporting to investors, they normally want the profit showing high. Quantifying damages, so if you've got a business interruption claim or a personal injury claim, that sort of thing. Often trying to show the business is really going great down until lo and behold, this is what caused it all to drop down. So if you can try and manipulate things, try and make it look like it's doing a lot better prior to the incident. Management they're normally remunerated if it's looking more profitable, so of course they want to show profit up. And a property settlement. So normally the business owning spouse will normally want to stay looking less profitable. And valuations, actually that's what we should put it on the other side, because the right hand side is all the ones who want it down. So normally if you're doing a stamp duty or a tax valuation, so you might be doing a restructure of your own business and you've got to get a valuation for file to justify it to the tax office.
Unless you're selling.
Unless you're selling, then you won't know.
Yeah.
Okay, so the reasons, some of the manipulation methods we go through, depreciation method, so the basis of accounting. Everyone heard of the cash basis of accounting or the accrual basis? You nod here. Which is the right one? Sorry? You got 50-50. Yeah.
It depends.
Depends, yeah.
If you're assuming it's accrual, then if you're something else.
Probably better explain what the two, you want to bring up, sorry. What is the cash, what is accrual? Cash, the revenue expenses are recognised only when the cash is received or paid out. So, whereas with accruals, think of your own business. When you render the invoice, you count it as income under accrual. Under cash, you don't show it as income until the customer pays. So, why would you use one, why would you use the other? Again, fully tax related. That the tax office allows you, accruals is the correct way from an accounting point of view. The tax office lets smaller businesses use cash if they want to. So normally it's to your benefit to only recognise income when you actually get the cash. You might do that. That was just a quick example.
Just as an example, very simple example. A business has sales of $100,000 in a year. The customers have paid $30,000 of it, and they've still got debtors of $70,000. So still $70,000 to collect. Expenses for the year of $50,000. We've actually paid all of those out. We've got no creditors. So if we look at under a cash basis accounting, how much we received? $30,000. How much we paid out? So we've got a loss reported of $20,000. Accruals basis, how much we billed? $100,000. How much we paid out? Oh. Even not wearing my glasses. $50,000. So under the cash basis accounting, we make a loss of $20,000. Accruals based accounting, $50,000 profit. Is there any difference in the way the actual business actually traded? No, it's the same business. One's reporting a loss, one's reporting a profit.
That's year one.
That's year one. Let's just say it stopped trading at that point. So at 30 June it stopped trading. What's going to report the next year? We've got great customers. Okay. So we've got $70,000 worth of collections, cash collections, no expenses in that year, $70,000 profit. Accruals basis, we haven't made any sales that year, we haven't paid any expenses that year, or incurred any expenses, so zero. So in the year that it doesn't actually trade, we've got a $70,000 profit on a cash basis and no profit on accruals basis. Again, same business, didn't trade. Under an accruals basis, on that first one, in your balance sheet you'll see debtors, creditors. And that's the big thing. If you're actually looking at a balance sheet, how do you tell if they're cash or accruals? If there's debtors and creditors, you're using an accruals-based accounting. If there's no debtors or creditors, it's likely to be a cash-based accounting, unless you're in sort of a cash business like a retail store might be. But which is the most appropriate there to use? Which tells you how this business is really trading?
Cash tells you how much money you've got. Yeah, there's an argument for both actually. Yeah, the cash does tell you this is exactly how much I've collected. An accounting textbook will tell you accruals is more correct because it supposedly matches when you incur the expense. So if you think of our practices, you pay the wages, you've rendered the invoice, you should marry up that income versus that expense. Under the cash basis though, you'll show all the wages expense, but you mightn't get paid for 6 months, so you'll recognise it next year. That's why they say the accruals is right, to try and get that matching principle right. Just going back to that example, if you remember cash, year one we lost 20 grand, year two we made 70. Across the 2 years we made 50. Accruals, year one we made 50, year two we made 0. Across the 2 years, 50. So across, when you look at multiple periods, it all comes out. And all these manipulations, just the way they work, normally if you do one thing in 1 year, it has the opposite effect the next year. And I'll show that again with stock in a second. We spoke about depreciation earlier. Just be aware there's 2 ways you can depreciate things. That's what they're called. Just as an example, illustrated, the straight line, it's got a 5-year life. You write off 1/5 of it every year. Diminishing value, the rate is always 1.5 times as much, but you depreciate the reducing balance rather than the original 10,000. So
This one here, you'll see depreciation to expense. You'll see the different expense in each of the years. Therefore, different profits depending on which approach you adopt. And written down value, DB, written down value. The book value is what you know.
So that'll be the net in the balance sheet. You'll see asset $10,000 less accumulated depreciation. That net balance is called the written down value, or we've had to abbreviate it, fit it on the slide as WDV.
Now, when we do our valuation, we look at what the written down value, book value is, and quite often that is what's going to be there, or that's going to be there. Does that reflect value, market value?
So if you look at the balance sheet, if they decide to go this way, you'll see the car at a value of $8,000. If they go the other way, the car's sitting at a value of $7,000.
This is a tax-driven thing. And just keep that in mind when you're looking at the values that are in the book values, written down values that are in a balance sheet. They're a derived result. There's no bearing to what the market value is. If it is the same, it's probably good luck and good management.
So you're allowed to use either way for tax and accounting. It's just accepted you can use both. The legislation, tax legislation, use both. The tax office put out a list of pages and pages of assets and what their expected life is. So that sort of sets this rate. And then if you want to use the other rate, it's always 1.5 times on that diminishing. Can anyone think of why there is a, that probably makes sense. You just say it's a 5-year life, or just write it off over 5 years. Why would you, how does that make sense to go and do it on a different way? Sorry? Oh, you still need to know the lifespan because you've still got to work it off that. But it's recognising some assets actually lose more value early on. So things like vehicles will lose a lot more value early on. But you don't have to, that doesn't have to be the case for you to decide to use that rate. And probably 98 times out of 100 people use that because they prefer to get a bigger deduction for tax purposes earlier rather than later.
Good point you raised there, though, the rate of 20%, how did that actually fit in? You have to, when you actually work through this, come up with what you believe is the effective life. So 20%, you're basically saying the effective life is 5 years. So effective life for a car may be about 5 years. If you're a taxi driver, is your car going to last 5 years? A taxi driver career is probably going to be 2 years. There's guides given it from the tax office to actually spell those things out. So there's another potentially possible manipulation. And then these manipulations, call it manipulation, it's not necessarily a bad thing, it's just what actually they're adopting to change the way it's actually being portrayed. It may be right to say, we're not going to get 5 years out of effective life out of it, we're going to get 2. We're going to write off over a shorter period of time.
So it's ultimately up to you as the business owner / taxpayer to say how long you think the life of it is and what's the applicable rate. Most people just default to the tax office because they then know tax office published rates. So now they won't have an argument with the tax office when they get audited. But things like even this fit out, most building work is a rate of 2.5%. They expect the building to last 40 years. If you've got a 10-year lease and you move out at the end of 10 years, you've only written off a quarter of it. You've still got a value on your balance sheet. It still shows you've got this massive fit out. If you're in the 9th year of your lease and you're intending to leave, potentially that fit out's worth nothing. Or it could even be worth negative because you've got to do a mate to it and clean the whole floor out. This is I'll do this one quickly because this is basically that cement driveway, bitumen driveway thing. So do we treat it as an asset? Can we justify it as an expense? Depending on what you're trying to do, but you're trying to lower your profit, you might try and claim it's only an expense.
The important thing there is who makes the decision. Does the tax office go through and actually make the decision for you? Or under self-assessment, does the taxpayer go, we're treating that as an expense, we're treating that as an asset? Which do you go? So there is choice in what they do. It may not be the right choice, technically, but the choice has been made, and that's what you're seeing in the financial statement.
So how we pick up that sort of thing is when we do a valuation, that's what we ask for 3 years worth of stuff. The accountant always says I want 3 years. So you can actually compare and see some trends and see if some number is abnormally big or small in 1 year compared to the other 2 years. That's really the main reason we're doing that. most business finance, if they're going to take out some sort of finance for their equipment, they'll either do a chattel mortgage, a hire purchase, or a lease. Chattel mortgage and hire purchase are treated, you own the asset from a tax point of view, and you depreciate the asset. A lease, though, the actual monthly payment you make is an expense. It's exactly the same piece of equipment, it's just how you choose to finance it depends on whether you end up with how you treat the cash payment, whether it's treated as an asset and you take up a liability, obviously, for your future finance commitments. So a quick example there. So we've got a $100,000 asset over 5 years, and it's 40% to pay at the end. So if we expense everything, which is what the tax office says you can do, your profit and loss statement might show $18,000 for the leases every year, and there's no asset and no liability on the balance sheet. If we didn't lease it but we hire purchased it, we'd end up with, sorry about all the numbers, but you're still paying out the same monthly payments roughly, but it's treated as interest, and there's also some depreciation that will be in the profit and loss statement, and you end up with an asset and a liability on the balance sheet. Exactly the same asset, just how you choose to finance it depends on how your profit and loss account and how your balance sheet end up getting affected.
One of the takeaways with that's going to be, if you see if you buy a $100,000 or $300,000 prime mover for a truck, the day you drive it out of the showroom, how much is it now worth? 250, 260. You've leased it. What's the liability the day you drive it out? 300. If you actually go through and treat it as just a lease payment, you'll see an expense now coming through. You won't see any asset and liability. So you know the asset's not, there's a lease payment expense in the profit and loss statement. You know the asset's not there, and you know the liability's not there. So they could be essentially what we call a negative asset. No, it's a negative equity sitting in there. Or it could be at the end of the lease where they've actually paid a fair amount of it off, and there's a positive asset sitting there. So the actual value of the asset is more than the actual liability. So if you see an expense amount, a lease expense, there's assets and liabilities done there, which could be a good or bad thing depending on your point of view.
And the other thing to be aware of is that most lease contracts, if you've got 60 payments of $1,000, if you go to them in month 5 and say, oh, I'll pay it out, well, I go, that's fine, just give us the other 55 months worth now. But if you do a chattel mortgage or a hire purchase, it's an actual principal and interest loan, and they'll give you a payout figure. But the lease, you've committed to paying that monthly amount for the term. So, as John said, the most important thing there is you've often got negative equity effects. It's actually what happens that isn't recognised on the balance sheet.
If you've got a business that has a very high capital intensive nature, chances are there's a lot of benefits associated with that. So have it all been put through.
There's an accounting standard that applies to public companies and large private, that have to get audited, so I don't want to bore you with details. It says you treat a lease the same way. Down in small, medium land, again, because it's tax driven, the preparation of the financial statements, they follow what the tax office allows, which is expense away the lease payments, monthly lease payments. This is just our asset revaluation reserve. So the directors, may choose to revalue it. So just be aware if you see that revaluation reserve. So I should point out there is one set of financial statements you'll see all the time that is revalued every year. Does anyone know what sort of entity has a set of financial statements read every year that is, of course, mark to market? So the blinds go up automatically. The sun goes down.
Super fun.
Super fun, yeah. Does everyone know that? With a company, a trust, a partnership, sole trader, what you'll see on the balance sheet is normally historical costs. A super fund does this revaluation thing every year. And every 3 years, it's a piece of property, you have to go out and get an external valuation to back it up. So if you're looking at a super fund balance sheet, it's probably going to be pretty close to exactly what it's really worth. If you're looking at any of the others, it could be anything. Okay, this is probably the most...
That asset revaluation reserve was down on equity. How is it really treated? Like if you just add it back up to the asset, you've got to pull it out.
It's already in the asset. So
okay.
The two sides of the transaction.
So the cost was $1 and the revalue was $2. So it helps
It's already in there for 2, and you'll have $1 down the bottom of the equity section.
So when you revalue it, you've got to debit the asset. So you'll debit it for $1 million to bring it up to $1,000,001. You'll debit revaluation reserve, a credit revaluation reserve. So the most common one probably for last, so stock. You're allowed to value again for accounting and tax purposes. Stock under one of 3 bases. Cost, most common because when you buy the stock, that's how it normally comes into your accounting system. Debit stock, credit cash when you actually pay for it. So at the end of the year, you go around and do your stock take. You're allowed to adjust your stock balance to either leave it at cost, which is what's sitting in there, or you might say, right, I've got $100,000 worth of stock that cost me $100,000, but that's obsolete, a lot of it. I'll only get $40,000 for it. So for my financial statement to truly reflect what my stock is worth, I should value it at $40,000 because that's all I'm going to get for it. But if they leave it in there at cost, potentially stock's overvalued by $60,000. Or you can bring it in at replacement value. So again, maybe it now costs, if you went out and replaced that stock, it cost you $200,000. So if you wanted to, under that scenario, you can increase your stock balance. And you want to do that example, trying to do an example that shows.
This example is something that we used to see this a lot, being tax-driven effect. You used to be able to go and carry forward tax losses 7 years. When you came to the 7th year, people were actually trying to manipulate their possibility to essentially recoup those losses quickly. So they'd actually try to create a profit to offset the loss. In the following year, they'd have a loss, which they can then carry forward for 7 years. They were trying to increase value. What we normally see now, because we can carry forward losses indefinitely, now we see people trying to reduce their profitability in a year. How that works.
So the other thing to remember with stock is the one account that affects the profit and loss statement. So if anyone's ever seen at the top of the profit and loss statement, you normally got sales, less cost of sales. Looks like that. Does that look familiar to anyone? That's the top of the profit and loss statement. The stock is also on the balance sheet. So if you adjust stock, you're going to affect your profit and you're going to affect your assets directly.
So this is part of the profit and loss statement. But this little section of the profit and loss statement, which is the top section, is what they call the trading statement. So it's really your sales, less your cost of goods sold, to work out what the gross profit on all your sales are. How it gets created is sales less cost of goods sold is equal to opening stock plus purchases, which gives you the total stock available to be sold during the year, less the stock that's left at the end of the year, must be what the actual cost of the stock was sold for. So the sales revenue less the actual cost gives you your gross profit. As I was going through before, we've got $85,000 worth of stock there.
Sorry, and the one rule is though, if you adjust, you can change that to one of those 3 methods, but whatever that number changes to, that number has to stay the same for your opening the following year. So if you just watch what happens.
Let's just say we want to reduce that to $50,000. So we say we actually don't have $85,000 worth of stock. We've got some obsolete stock. Stock take comes through. Director just marks it down to $50,000. What happens to the profit? Exactly what Peter was talking about before. This year the profit drops, but you get the corresponding gain the following year. A couple of things to note here. You would have seen before we had 24, 25% worth of gross profit percentage, which is your gross profit divided by your sales. When we made that adjustment, look at the actual GP percentages. A business usually trades relatively consistently from year to year. You'd expect your gross profit percentage to be similar from year to year. If it's not, you'd have to question why. Why has it actually changed that dramatically from 15 to 32? Why is it increasing so much? But the thing is, you normally see, if we use the 30 June 2016, we're seeing the 15%. We're not seeing the effect of the following year. So the important thing is you'll see when we actually ask for, we have the last 3 years to get our trend, but can we also have year to date? And why we want the year to date information is in July of the next year, that reversal of that stock adjustment will come through in that month, unless they're making that adjustment then as well, which means it'll come through in the next month. But essentially they'll get called out eventually if it's not correct. By getting the next period, you'll see that reversing effect come through. But actually more than that, if we're actually going for a month, we won't have $500,000 worth of stock. we'll have, Peter, what's that? Ben, you'll know what that is. What's that? $50,000, $45,000 worth of sales for that month. But we'll see the $35,000 adjustment come through for stock. So suddenly this gross profit margin won't be 32%, which is what you see for 12 months. For 1 month, it'll be extraordinarily high. So that's why we ask for always that year-to-date information.
So the riddle is, if you increase your closing stock figure, your profit will be higher. If you decrease your closing stock figure, your profit will be lower. And obviously the opposite happens the following year. And then again, when you come in to look at the balance sheet, you've got to say, well, what is the stock really worth? And just be aware which methodology it's been valued under and whether you need to adjust it. So just some other things to be aware of. So normally when you're looking at a business, you assume it's a going concern. So if you're doing a valuation, for example, it's never made a profit and you're questioning whether it's a going concern, all those values you're looking at on the balance sheet, things like the fit out, if you've got to vacate the premises, is that fit out worth anything at all? Or again, is it a negative because you've got to do a make good, things like that. It's not a going concern, all bets are off when it's in terms of the valuation of the asset. Has anyone ever heard of materiality? When an accountant talks about that's not material. I don't think it's a problem, it's not material. But the thing is, originally, everyone thinks accounting is precise to the last dollar. Materiality says, and it comes from an audit point of view, when auditors are checking things, there's a bit of grey. So, use stock as an example. The balance sheet says there's $100,000 worth of stock. The auditors come along and verify it all and check it and say, no, there's not. There's only $97,000 worth of stock there. That's $3,000 difference, or 3%. That's what's called not material. Less than 5% difference, the auditors can't say the accounts are wrong. They're still going to say the accounts are true and fair, because they're within 5% of being totally what they think is true. Totally correct. Between 5% and 10% out, there's a bit of an argument between the auditors and whatever it's at, whether they think it's that big a deal. More than 10% out, they will say the accounts do not reflect the true and fair view of the state of affairs. So just be aware that accounting
that's auditing. That's if you actually have audited financial statements. Yeah. How often do you see audited financial statements? There's a misconception that if you're actually looking at audited financial statements, they're audited. They are right. That's not correct. What an auditor does is goes through a random sample and tests a series of things, and it may only be a sample of 50 transactions out of 1,000. If they're right, they tick that account off. All they're doing is basically doing a test check to see if it looks about right, and they're applying these materiality concepts. We often get asked you need to go and audit, your instructions are to audit those financial statements. The reality is you don't want an audit done, because an audit is following a whole lot of procedures, and they do it for everything that's there, so it's an expensive process. It really only dips your toe in the water. What you're after is the validation process. 95% right. Yeah, traditionally. But that 5% may be where the problem is. What you're after is the validation process. You're concerned about sales. You want sales validated. You're concerned about wages. You want wages validated, or cost of goods sold, whatever it might be. But the validation process you want. When I first started my career, there was one of the audits. They were doing a audit of the stock. And it was a large manufacturer of those big farming tractors, the big dual back wheel, big things, great Tonka trucks. And it was just a mammoth shed after mammoth shed after mammoth shed of counting. So everyone was walking along, and the audit team would walk along going 1, 2, 3, 357. And while it's happening behind the shed, they're reversing this truck. Yeah, you're driving up the other end, and they're 426, 427, and it got picked up for whatever reason. But that's the process. It's not a perfect system. So audited financial statements don't mean they are right. Audited superannuation fund statements doesn't mean those statements are right. There's different ways to look at it, and it's really worth exploring what you're trying to achieve.
Having said that, it definitely gives you more comfort that they're right than non-audited ones. Otherwise, why people file with audits? We spoke a little bit about cash flow versus profit when we were talking about cash versus accruals before. You might have a business that's highly profitable but got no cash flow, so that's something else you need to consider. If all that's happening is that profit is debtors that are going up, and you're never collecting your cash, have you got a sustainable business? Value is another whole session, which is on a month or two. I think there's all sorts of value. Things called provision. So again, for tax purposes, provision for annual leave. Anyone ever heard of that? It's a liability. So if your staff all leave, you've got to pay them out their holiday pay. But tax office says until you actually pay it out, you can't claim it as an expense. But from a valuation point of view, we still recognise it as a liability. But you rarely see it on a balance sheet, again, for that tax reason, that it's not an exception.
And it is a liability,
yeah,
but it's not payable yet. On the leave being taken. Another one is long service leave. Long service leave doesn't really kick in until year 7 to 10. So you may have a large client base who've all worked for 6 years. And the actual, if you accrued that amount, it would be $500,000. But because they've worked 6 years, not 7 years, it doesn't enter anywhere. When you bring it to account, if you're buying that business and they're all 6 years and you're taking those employees on, taking that essentially that 6 years on board, do you want an adjustment to the liabilities there? Because in a year's time, suddenly something clicks in. So it's asking those sort of questions, superannuation, because you don't get a tax deduction until you actually pay it. If they haven't actually paid their super, is it on the books? Sick leave, bad debt, the whole of those provisions that are essentially out there, and the higher quality of financial statements are more likely you're going to see them.
You might notice the superannuation isn't 9.5% of wages, and think, well, why isn't it? Well, they might have been a bit short of cash towards the end of June. As long as you pay it by the 28th of July, you don't have to pay the guarantee charge and all that other stuff. So maybe that year you're looking at, they haven't paid it, so that's an extra expense that should really go back into that year. And we spoke about contingent events that aren't, they won't appear on the balance sheet either because they're not a legally enforceable debt, for example, yet. Nor will after balance date events. So if something major happens on the 21st of July, that won't show on your 30th of June balance sheet. You might have had a fire and all your stock's gone up in smoke. Well, 30 June, yeah, you still have 100 grand worth of stock. So the balance sheet is staying in the correct position at 30 June. But you need to be aware of potential things that have happened since.
Probably one of the biggest ones for valuation due to what we saw 2 years ago was in 2008, 2009. We're looking at the 30 June 2008 figures. Things are looking fantastic. It's like an event that happens the next couple of years. You didn't see that anywhere. So these accounts are showing great results. But we know that these things are tanked.
So, last one, things to be aware of. Who prepared the financial statements? Are you looking at a set of audited accounts at the best end of the scale, or is it something off a word processor? I mean, we do commercial litigation cases where people are doing for misrepresentation, and they say, when I bought this business, I was given these financial statements. And what you actually get is one page, it's a profit and loss statement, it's just been typed up. And who the hell did that? Where did that come from? So has it at least been prepared by a CPA or a chartered accountant and it agrees to the tax return? That's probably the minimum level of what you try and get.
And also with CPAs and chartered accountants, they've got a regulatory body sitting behind them saying, if you stuff up, we'll discipline you and we'll take things away from you. If you're a bookkeeper, covered by absolutely nothing. And work still, the individual whose business it is, they're motivated to a result. So how that's been.
So again, just be aware, 95% of the time you're looking at a set of accounts that are prepared as the basis of the tax return. Dominant motivation there is lower your profit as much as possible. But again, it might have been that misrepresentation case where they've just typed up a nice little profit and loss statement that says what it is, and they're trying to show this thing's really going well when it's not. Is the thing you're looking at a company that runs a business and also does a couple of other things? So, you often see sales, cost of sales, blah, 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 other income, trust distributions received. That bears no resemblance to the underlying business. So if you're trying to value the business, is just got to strip out any of those income and expense items that don't relate to the business. And there's probably a very important thing is a reporting entity versus a non-reporting entity. So non-reporting entities are companies, trusts, whatever, that don't have any outside shareholders. So basically, non-family type businesses. So the rationale is, well, you're intimately involved in the business, you know what's going on, so you don't have to do the 100-page report like BHP does. You can just do these short form things and everything's fine. But from an accounting standards point of view, if you've got outside shareholders, there's more stringent requirements to follow. Any questions? Explain it all perfectly.
Did all go back to what's there on?
You should have all, you didn't already get all our invites. There was just about everyone in the room is a family lawyer, I think. Yeah. So a lot of these are family law oriented, but the ones John and I do are, pretty well anyone who has anything to do with financial statements, but the ones the other guys are doing, super, financial planning, digital forensic, Dan's gone. So Dan Haynes was here before, he heads up our forensic technology division, so he often he has all sorts of tools that he can use for data mining and various things, but he also analyses phones, which is done for family law cases.
He's the guy that has those fantastic stories. He's got a 15-year-old laptop that didn't work, and he pulled it out and he ripped stuff off it, and the guy's done for pornography, and we've gone into a photocopier, and the photocopier's got a storage device in it. Look at everything else, the storage device. He's done the GPS off phones, so you see where people are actually going over a period of time. And we've married that up to credit start to actually put a story together for a period. Another one he didn't do this one, but was a GPS on the car, tracking the movement where the car's gone. There's lots of that digital side is actually sort of scary. What they can do. Tax is really the important part. We've got a family law bent for that one. The important parts of tax for business valuation. Peter and my job at times talking about what goes into a business valuation. How do you compare it? What are the methodologies? You go through there. Superannuation, again, superannuation, you know, is changing readily. There's been some changes coming through in the last budget. What do they mean from a family law point of view? Looking at the main things. And then business analysis is really the second part of this session, where we actually go through what do the documents mean. So all of those documents are there, the plus ASIC documents or tax returns or going through financial statements, breaking them apart, what's the story behind it. So going through really practical side of the business analysis. Financial planning, this is one that I've got a personal little thing here. I think financial planning needs to get more and more into family law. There's a rule out there that basically says you can't give any advice in relation to something security. So with the exception of the house, you can't comment that they should take the business, they should take whatever it might be. We're all hamstrung by that. Financial planners come in and they actually talk about that asset allocation. What's good, what's the cash flow associated with something, what's the risk associated with something. I just think there's, from a property settlement viewpoint, there's a real, I think, opportunity there to really grab financial planners. Business valuations, what goes wrong? The top 10 things we see go wrong. And there are a lot of really common ones that we see in the traditional forensic. So here's our quick valuation. Anything you'd like to see change, we can think with this one, but more importantly, what would you like to do about it? Would you like to hear auditors coming to talk about auditing for a whole hour?
Notice